So I want to kick everything off a little bit different tonight than last time. I want to take a poll. So poll number one. So how do you currently feel about the stock market? That's a pretty easy one. Optimistic, it's rebounding and I think it has room to grow. Cautiously optimistic, so you're still okay, but you're staying diversified. Nervous, you don't think the rally is sustainable. Or I try not to think about it too much, that's what I pay you guys to do. All right, so who says A? Okay, all right, good. Who says B, cautiously optimistic? Okay, all right, think a little bit more. Who says nervous? I'm not sure that this rally is sustainable. All right, a couple. And then who says I don't really think about it? All right. All right, that was actually pretty evenly spread out, but I think B caught that one. All right, number two. What's your biggest financial concern right now? Is it rising inflation, interest rate uncertainty and ballooning government debt, market volatility, political and geopolitical risks, or outliving my savings? So who says A, rising inflation? Nobody. All right, good. Who says B, interest rate uncertainty and ballooning government debt? All right, got a few of those. Who says market volatility? Okay, a couple of them. And then who says political, geopolitical risks? Okay, all right, I think that's the winner. And then who says outliving my savings? All right, okay, so we got, all right. And then third one and last one, tariffs have been in the headlines again. What's your take? A, they're a short-term headline risk. I try to ignore the noise. B, they could impact my investments and I'm watching closely. C, I'm not sure how they affect my portfolio. And D, tariffs make me more cautious about investing and make me nervous about my financial situation. All right, so who says A, they're a short-term headline, I try to ignore the noise? All right, very good. Who says B, they could impact my investments and I'm watching closely? Okay. Who says C, I'm not sure how they affect my portfolio? All right, very good. And then who says D, tariffs make me more cautious about investing and make me nervous about my financial situation? All right, you got a couple there. All right, so let me see the hands for A again. Okay, and then let me see the hands for C. Again, I'm not sure how they affect my portfolio. Well, that's a close one. What do you think, Eric?
I think A.
A? All right, cool. All right. So that's pretty good. All right. I think that pretty much sums it up for, I think, how the general public, I think we have a pretty good spread here of people from all walks of life. So I think you'll see tonight from conversation that most people probably think the way that you do. They're kind of like, I guess I'll say like almost like in a wait and see mode. I think if that's fair to say. So without further ado, let's get started. So the first question. All right, Eric. Markets were falling earlier in the year and now they're bouncing back strongly. What changed?
Well, it's a great question. It has certainly been a lot that's taken place so far this year, and I have a feeling as we go through the second half of the year, we're going to have no shortage of events taking place to keep things interesting for markets. But it was interesting, so much was made about the tariffs that were announced on April 2nd and how they pushed the market lower. And it made sense because you look at the S&P 500 and you see it in the chart up here. The S&P 500 fell by 21.3% from February 19th to April 7th. And if you're taking the textbook definition of a bear market, a 20% drop or greater in the S&P 500 is what is considered technically a bear market. So we had a very short-term bear market that took place over 2 months worth of time, less than 2 months worth of time. But one of the things that's notable about it is that, yes, Liberation Day, April 2nd, when all those tariffs were announced, it sparked a lot of downside volatility. But the fact of the matter is that the market had been correcting for about 6 weeks before April 2nd took place. The market peaked on February 19th. more than a month before Liberation Day and those tariffs were announced. And what's notable as we look in retrospect, it was on April 7th, only 5 calendar days after Liberation Day tariffs were announced, that the market actually bottomed and we started into a rebound. Now, there was a lot of forces at work at the time. I mean, we could have seen further declines if we didn't see the 90-day pause in the tariffs. I mean, the angst that was taking place in the markets at the time there in early to mid-April, I mean, that was legitimate. You talk to institutional money managers at the time, because the tariff announcement was so different than what the market was prepared for, institutional investors, retail investors, everybody was stepping back because they're just like, whoa, okay, all these tariff numbers are so different than what we were projecting. We need to see how this plays out. And that 90-day pause kind of was the release valve to say, okay, well, this is going to be put off for 90 days and we can kind of get back into the markets in the meantime. And that was laid the groundwork for the rally that we've seen since. But there was a broader context behind the correction. Again, peaked in February 19th. What gets lost sometimes is the fact that the market rally that peaked on February 19th of this year, it got started in Halloween of 2023. Normally, a market, when it moves, it doesn't go straight up over time. A healthy, normally functioning market is one where you'll see like 3 steps forward, 1 step back. 3 steps forward, 1 step back. You'll have pullbacks that take place along the way. But what we saw from Halloween in 2023 all the way up through February 2025 was a market that had basically taken like 15 steps forward and no steps back. We were so long overdue for a market correction by the time we hit the middle of February that it played into the severity of the correction that we saw. If you have a market rally that, over 50% rally over 15 months, you're going to get some sort of pullback in terms of regression to the mean to kind of wash some of the excesses out of the market. And that's a lot in part of what we saw there at the beginning of the year. It's not that the fundamentals changed. The tariffs had people thinking that maybe the fundamentals could change, but the reality of it is that economic growth continued to be strong and is continued projected to be strong. Inflationary pressures were continuing to abate. We're now a couple years or 3 years removed from the inflation of 2022. And corporate earnings were still projected to grow at a double-digit rate. If we think of the one factor that's going to drive stock prices higher more than anything else, it's corporate earnings and the growth of corporate earnings. We saw the S&P 500 rise by 25% in 2024. And that was driven by corporate earnings growth that grew by about 8% on the S&P 500. So a 25% gain on 8% corporate earnings growth. Well, what is the projected corporate earnings growth in 2025? It's about 12%. And we're, roughly, for all intents and purposes, flat for the year so far. So it was a correction that was overdue. Should we have seen 25% gain in 2024 on 8% earnings growth? No, that was probably a little ahead of itself. But a lot of that excess has been washed out in the markets that we've seen so far this year.
All right, that's it. We're all done for the night. No, I'm good. Okay, kidding. All right, so the market's obviously rebounded quite a bit. Do you see this as something that can continue? Or maybe I should ask, what can help this continue, right?
No, that's a great question. So this is this would be the first takeaway for tonight, at least in terms of the predictions from this chief market strategist. And as Ricardo mentioned, these are all opinions in the disclosure section. We are on track to hit new all-time highs in the S&P 500. We hit 61.19 on the stock market, the S&P 500, in February 19th. We're kind of going back and forth around that 6,000 line here as we sit here in the middle of June. We're on a path. We should not be surprised at all if we see the S&P 500 trading at new all-time highs by the end of June, maybe the middle of July. I'd probably say the middle of July is a little bit more likely because what's going to take the S&P 500 those last 120 points plus to the upside at this point? On June 18th, we don't have much of a catalyst right now. We're entering into the summer. We're pretty close to the end of the second quarter. We had the Fed meeting today, but the Fed didn't do anything in terms of raising or lowering interest rates. We kind of have a clear path to the end of the quarter. But once we get into July, we get into the start of second quarter earnings season. We start to get a whole new stream of economic reports. One of the things that we historically see, we get into July, we get into second quarter earnings season, stocks tend to perform well during earnings season. And part of the reason they perform well during earnings season is because you have 500 companies in the S&P 500 who are coming out and they're giving an update in terms of what their outlook is. It gives investors more certainty. One of the things that markets hate more than anything else is uncertainty. You get updates from 500 companies that make up 85% of the stock market, you got a lot more certainty, and that's one of the reasons why stocks tend to do well in earnings season. So by the middle of July, I wouldn't be surprised if we see the stock market at new all-time highs.
That's a perfect segue. People are going to think that we're actually starting to rehearse this beforehand.
We don't want to give away.
No. All right, so let's go into earnings. All right, are businesses doing better or worse than expected?
It's amazing how well corporate earnings have held up this year, and the projections for corporate earnings held up this year. I think back when we were at the beginning of April, and because earnings season basically takes place around, from the middle of the first month of the quarter. So in this most recent case, it would be like the middle of April through the middle of May. So for next earnings season, it will be the middle of July to the middle of August, where these companies report. One of the big questions going into first quarter earnings season wasn't around how companies did in the first quarter before the tariffs were announced, because the economy was, I know GDP went down 0.3% first quarter, but a lot of that had to do with the fact that people were importing goods in the first quarter because they're just like, hey, we're hearing all these tariffs are coming, so if we want to buy our European sports car, if we want to buy, our goods from Europe or from Asia, we better go out and buy those now. Like, I remember going to the car wash and a woman got out of her car and she had a Mercedes and she was just like, yeah, I went and got my car repaired because I figured the repair costs are going to be lower. And this was like in March. I figured the repair costs are going to be lower now than they were, with all these tariffs coming. The big question going into first quarter earnings season in the middle of April, how much were corporations going to revise their profit outlook lower given all of these tariffs that were being announced? And what we came to find is that corporations were almost like, we're all good. We're optimistic about this economy. We see growth in our outlook through the remainder of the year. We just need to know what's happening with these tariffs so we can plug a new number into our projection spreadsheets. But once we get that number, we feel pretty constructive about things. Companies really didn't revise their earnings outlooks lower much, if at all, in the first quarter earnings season, and that was in the midst of all of this tariff uncertainty. So as we go into the second quarter earnings season, economic growth outlook, are we seeing some weakening on the margins of the economy? Sure. But the economic outlook continues to be pretty strong. There's certainly a worry about inflation, but I think the room here tonight has it right when Ricardo asked those questions, and there was maybe one person that raised their hand about inflation, because inflation continues to be under control despite the tariff announcements. That is a perfect environment for corporations to look out in the second half of the year and say, hey, we got economic growth, inflation's under control, and people are still showing up to buy our products despite what anybody might be concerned about with an economic recession. We feel pretty constructive about it. So it looks pretty good going in the second quarter earnings season.
So I want to double click on something here. Mia, can you do me a favor? Can you go back one slide? There you go. Okay. So right there at Liberation Day, when we had the next day after Liberation Day, when we had the lower peaks of the market, it was the beginning of April, right? So it was the beginning of earnings season, right? And then we saw that amazing comeback that we're still in, and most of that, I would say, is from the 90-day pause. How much of that do you think, not that you have to give me a number, but how much of that do you think is also because investors said, oh, these companies are all in good shape. These earnings are still in good shape. Nobody's really revising their numbers. Like, how much of that do you think is actually the rest of it, versus, that initial kind of sigh of relief?
Yeah, I think there's several factors at work here. One, I remember when we were in the midst of the market pullback, the kind of the tariff-induced market pullback. One of the things that we were saying at the time is that this is a man-made market pullback. This is a human-made market pullback. It's not as though we're seeing the economy go into recession. It's not as though we're looking around and seeing corporations slashing their corporate profit outlook. All of the fundamentals continue to look good. It was just the uncertainty associated with the tariffs. So the way that we were describing it is that this is almost like a slingshot, where the further the market was going down, it was like the slingshot was being pulled back further and further. And once we got the release, 90-day pause in the tariffs, boom. The market was shooting to the upside. One of the things that's so notable if you go back and look at market history is that there is an amazing amount of symmetry that exists when you have these pullbacks. Market from February 19th to April 7th fell by 21.3%. That's roughly a 6-week period. If you take a look at that chart up there, the recovery to get back most, not all, but most of the decline that we saw from about April 9 through the middle of May, 6 weeks. We see that over and over again. There tends to be a great amount of symmetry. The further the market falls over a period of time, you will see a matching recovery and a pace that recovery. There is a reason why the market rally in April, starting from the middle of April through the middle of May, it was the best market. It was the best period of market performance over a 19 trading day period that we've seen since 2004. And the reason that is because the decline that we saw was equally as swift to the downside in reaction to the tariffs. So the fundamentals were strong. The liquidity was still there in the marketplace, and that's another important point. There's the symmetry in terms of market pullbacks. The fundamentals are strong, but the other aspect that's really important to note is that there continues to be a tremendous amount of liquidity in the financial marketplace, so that once investors get comfortable with the idea of buying stocks or risk assets for that matter, we look at gold, $3,500 an ounce, it's because there's a lot of liquidity out there. And when I say liquidity, that basically means money in the marketplace that investors, both retail and institutional investors, can use to go out and buy stuff, buy stocks, buy bonds, buy commodities. It's still in abundance in the marketplace as we're sitting here in the middle of 2025.
All right. Thank you, Eric. So I want to move forward a little bit, and I want to talk about inflation. We don't have to spend a whole lot of time on it because it doesn't seem like anybody here is really too worried about it. But I do want to talk about it a little bit because that's what you hear about a lot on the news, on TV and radio, whatever, the Wall Street Journal, whatever you read. That tariffs may affect inflation pretty negatively, right? That's one of the reasons why the Federal Reserve is hesitant to reduce rates, because they don't have any clarity as to what inflation's going to do. So let's talk about that a little bit. What do you think the current situation is, and how do you think it would affect us as investors?
No, it is something that I've been saying since the middle of 2023, and I'll continue to say as I'm sitting here in the middle of 2025. The number one downside risk for stocks, for bonds, for commodities, for gold is a renewed rise in inflation. It is, I've talked positively about what we're seeing in terms of the inflation data so far. Really going back the last few years, we have seen inflation data consistently falling. Inflation itself is rising, but the rate of inflation continues to fall. We have headline inflation now that's back below 3%. We have core inflation that's closing in on, back below 3%. Having taught macroeconomics for years, those are textbook numbers. You got inflation in between 2 and 3%. Corporations growing earnings at 10%. You can get a stock market that will rise all day long in that type of economic environment. But there's a reason why 2022 was such a painful year for investors. We had the worst outbreak of inflation in the U.S. economy going all the way back to the late 1970s and early 1980s. We saw the headline inflation rate hit 9% and core inflation approach 7%. The stock market fell by 26.5% over the course of 10 months, and the bond market also fell by double digits in 2022. I mean, that is a rough combination when stocks and bonds falling at the same time. And the reason that was taking place was because of inflation. If you have high inflation, well, all of a sudden, it's a lot harder for corporations to make money. We talked about corporate earnings growth. All of a sudden, that flattens out, if not turns corporate earnings growth negative. And it also means that if you're a bond investor and you say, I'm getting a yield of 5%, but if the inflation rate's 9%, you're losing money on that bond investment because prices are rising faster than the coupon that you're receiving from your bond. So people will sell their bonds as a result. This continues to be the number one downside risk for investors because you have those forces at work, but there's another element of it too. If you have too much money chasing too few goods, I don't want to Econ 101 nerd out here for a second, but if you have too much money chasing too few goods, which is your definition of inflation, how do you stop the inflation problem? You take money away from people. You take liquidity away from people. The Federal Reserve raises interest rates. That's the Fed taking liquidity out of the market, taking money away from people. What can you not do if you don't have money? You can't buy stuff, which causes the inflation rate to go down. And you also can't invest in stocks and bonds because the money that you used to have is being taken away from you. So when the Fed is raising interest rates, that's one of the reasons the markets will correct, is because institutional and retail investors are having liquidity taken away from them. And that's another force that pushes markets down. So the concern about inflation, monitoring that risk. Now, I'm constructive on where we are in the inflation outlook. If you opened up the Wall Street Journal in the beginning of April, every single headline was like, oh my God, we got tariffs. It's going to be a big inflation problem. And that was part of what was spooking investors at the time. But here we are 3-4 months after the fact. We're not seeing an inflation problem yet. It's still important to monitor. Looks good at this point. But it was one of the things that the market was reacting to at the time. So we want to continue to see that inflation data soften through the second half of the year. So if you hear people talking about the worries about an economic slowdown, I would actually contend that's going to be a good thing for markets. Because if the economy is slowing, that's a disinflationary pressure. It's something that will help keep inflationary pressures in check as we go through the second half of the year.
Okay, we're going to move on in just a minute to investor confidence, but I want to ask you real quick. Do you think that one of the reasons why inflation has been able to stay in check this year, even with added, because even though there is a pause in tariffs are in fact higher than they were in the beginning of the year. Do you think that one of the reasons for that is just the efficiencies that companies are able to do now compared to what they were able to do in like 20 years ago with technology?
Yeah, that's absolutely right. I mean, one of the things that is great about the technology, the gains and advancements in the way that we do things, I think of one thing that is one development in recent years that has been a tremendous value add, and we are only scratching the surface in terms of the value that companies and individuals are going to be able to derive from it, is artificial intelligence, AI. We're only at the beginning of that. Corporations have become very effective in terms of managing costs. And managing production, managing their supply chains. That was really put to the test during the COVID crisis. But that's one of the forces, is that not only are companies more productive and more efficient in terms of the way that they manage operations and have the capability to do so, but we as consumers also have a greater degree of flexibility. You know, if prices rise for a certain good in one place or another, hey, I'm going to jump on the internet and find it from somewhere else. We as consumers have a lot more flexibility in terms of how we can make our purchases. You know, this isn't the 1970s where, you know, fuel costs rise and all of a sudden, you know, there's not the flexibility in terms of manufacturers and producers to manage those costs. And we as consumers have a lot more flexibility in terms of how we're consuming and how we're making our purchases than we did 30 or 40 years ago. So it's really on both sides, as well as that productivity element.
So you and I have talked about this before, and this is in some of your writings talking about investor confidence. And I think even from the poll that we did tonight shows that investors do have confidence in I don't know if it's the market or the economy or their situation personally. But what do you think is causing that? What indicators are you seeing that is telling you that investors definitely have confidence?
It's really, I would say the best barometer of investor confidence more than anything else, and this seems kind of elementary, is the performance of the stock market itself. You know, when we were going through the spring, one of the things that we kept hearing is, like consumer confidence and consumer sentiment, the soft data. We were seeing a lot of weakness in the soft data. And justifiably so, because there are so many things that were happening in the first half of the year. Yeah, the tariff announcements and, the economy slowing. And I mean, there was like a barrage of headlines that were hitting the news wires every day in terms of this happening or that happening. Investors don't like uncertainty. And there was a lot of things to be uncertain about. So what the contrast that we saw in the first half of the year is that, yes, there was concerns about things, but the hard data continued to be strong. Projections for economic growth, projections for inflation, projections for corporate earnings. Those hard data points continue to be strong. As long as the hard data holds up, that's the type of fuel that can propel a stock market that's going through a period of weakness to recover as quickly as it did. Because as long as the fundamentals are there, investors who are thinking about investing in the market, they have tangible things that they can point to justify, to say, you know what, this is a good investment because economic growth is strong, because inflation remains under control, and because corporations continue to grow their earnings despite all of the news that I'm trying to navigate in the meantime.
So do you think that now is a time for a little bit of caution because the market's rallied back the way it has been, and investors are confident? Sometimes that could be kind of a contrarian indicator. Or do you think that we're still in good shape for continued good behavior of the market? Let's put it that way.
Yeah, normally, this may be a surprise to some of the people here who've heard me a couple of times, because I've been pretty, what you describe as bullish in terms of optimistic about the market outlook. I'm no stranger to be bearish. If I was sitting here in like 2015, 2016, 2017, I would be much more bearish to say, hey, you know what? The fundamentals behind this market are relatively weak. Let's just say it's the middle of 2016. Economic growth chronically sluggish. The Federal Reserve struggling to, hold off deflation, which is a totally different ballgame. We're talking about inflation. If we think inflation's bad, deflation is a lot worse. And corporations, like earnings growth was okay, but it was kind of back and forth. Yet the stock market just kept rising and rising and rising because it was getting so much liquidity. It was setting up a market in the mid-2010s that was artificially inflated. We have the opposite condition that's taking place right now, particularly in the wake of what's taken place earlier in the year. The market is corrected. It's mean reverted. Basically kind of, it's let off some steam. One of the things that really stands out, if you could go back to that previous chart, one before that one. One of the things that stands out We've had a market that has rallied tremendously. We hit 4,800 on the S&P, 4,835 in the S&P 500 on April 7th. We're back above 6,000. That's a more than 20% rally from the lows on April 7th. 3 steps forward, 1 step back. You have that type of rally that takes place over a 6-week period in the markets, you should presume that you're going to give some of that back. One of the things that stands out in the last 3 or 4 weeks is the market hasn't really given any of that back. If anything, there was that brief blip there in late May for about 3 or 4 days, and then it just picked right back up, and it's continuing to grind to the upside, even though we've seen some momentum come out of the market, some relative strength come out of the market. We've seen some consolidation is what we referred that to. The market is continuing to grind to the upside even despite this consolidation. There's another thing that really stands out about this, particularly what we've seen in recent days. So we're here last Thursday, and the market was putting in another good week last Thursday, and then all of a sudden the markets close and we go into Thursday night, and what happens is that we have the outbreak of conflict in the Middle East. We turn on our televisions, we open up our newspapers, and all of a sudden we have Israel launching an attack on the nuclear apparatus of Iran. One of the things that and this is your geopolitical risk. I think we saw the most hands go up in the poll that Ricardo gave earlier, the concerns about geopolitical risk. What's really notable, did the markets pull back on Friday? Yes, but it was by like 1%. We went into the weekend, it's not like anything was resolved on Saturday or Sunday. But when the markets opened up on Monday, we basically made it all back and are trading higher now than where we were pre-attack, the pre-Israel attack. That provides just additional evidence in terms of the sentiment that's in this marketplace right now. Despite a geopolitical event breaking out, the market's pushing right through it. So that's a very positive sign in terms of the sustainability of this market we're in right now.
So I'm going to double click on that for 1 second here, because considering the geopolitical risks that we have currently, you have Israel attacking Iran, which is a major oil producer. Now they haven't really attacked any kind of like oil reserves or supplies on Iran's side yet, but let's say worst case scenario they do. They say this is a little bit more prolonged than they do, and now you see Iran start a blockade of the strait there where they have all the oil going through between them and Oman. That's going to send oil prices high. I'm going to go out on a limb and say that a reason why inflation's been kept in check all year is because oil has been extremely low. It's been in the 60s and now we're in the 70s. Going back to your earlier point about inflation being one of the highest risks, how does geopolitical risk then kind of boil into inflation risk? Can you? Yeah, no, it is a huge factor because we're tying in the threat of inflation associated with geopolitical risk. And if we reflect back to February of 2022, we can all remember Russia invading the Ukraine, February 24th, 2022, oil prices spiked, and the stock market didn't do very well in the months that followed the Russian invasion of the Ukraine. So there's a good reason to look at the threat of geopolitical events and how they're going to potentially adversely affect financial markets. So with that backdrop, my recommendation, my suggestion, a point that is good to keep in mind, when you have the markets pull back based on geopolitical risk, more often than not, it provides a great buying opportunity. We have 150 years worth of stock market history to analyze how markets respond to geopolitical events. And there are any number of events that we can talk about. One of the things that we typically see is that the markets, they might pull back for a day, like they did last Friday, 2 days, 3 days, 4 days, maybe a week, maybe a little bit longer. But more often than not, when you have geopolitical events, the Kennedy assassination,
The attempted assassination of President Reagan, the first Gulf War, the second Gulf War, the invasion of Iraq, the events of 9/11. We talk about markets potentially getting worried about Israel launching an attack on Iran. Let's draw back the scope and let's go back in time, if we will, 24 years to September 11th, 2001, where a surprise attack was launched on the United States at the direct heart of the financial system in the United States, in the World Trade Center in New York City, toppling two of the iconic buildings that represent the U.S. financial system in a single morning. The stock market was closed for 4 days in the aftermath of the 9/11 attacks, in part because of the damage. The New York Stock Exchange was flooded that morning because of the damage associated with the collapse of the World Trade Center. The markets reopened that Monday, and they trade lower for the first 4 trading days. So September 17th to September 20th, the markets trade lower for those first 4 trading days. But then they bottom, and then the markets start to rally. And by the time we get to the middle of October, 1 month removed from a direct attack on U.S. soil, arguably the biggest geopolitical event that has taken place in the last 70 years in this country, and the market is trading higher than it was before 9/11. And that rally continued through the rest of the year in 2001. In the midst of the bursting of the technology bubble. There was a pretty bad bear market in the U.S. stock market from 2000 to 2002. The stock market rallied in the fourth quarter of 2021 in the aftermath of 9/11. What was part of the forces that was driving that? Liquidity. What did the Federal Reserve do along with other central banks around the world? They injected a massive amount of liquidity into the global financial system in order to stabilize investor confidence. And that was a big, you put that liquidity in the hands of investors, they're going to put it to work. Let's go back to another geopolitical example. I'll take the ante up even further. It's December 7th, 1941, the Japanese bomb Pearl Harbor. We are 10 years, 11 years into the Great Depression at this point. And the stock market didn't really do very well in the 1930s into the 1940s. Now, the market moved lower for about 3 months, but that was a part because we were transitioning from a peacetime economy to a wartime economy, which hurt corporate earnings. Corporate earnings were declining during that time period as the economy was adjusting. In April of 1942, the stock market bottoms. And this is April of 1942. We have some carrier battles going on in the Pacific. We are about 2 years removed before the invasion of Normandy. There is a lot of uncertainty at this time in terms of how this whole thing is going to play out for the entire world. But over that same time period, from April 1942 through the end of 1945, the stock market steadily rallies and effectively doubles over that same time period. So the broader message there is that if the stock market can respond well in those 2 geopolitical events, it can certainly see its way through anything that's taking place in the Middle East right now.
I kind of threw that one on you, so good answer. All right. So let's go into bonds, right? Because that's thought of the safety play. I ballast my stocks with my bonds because if stocks go down, usually bonds go up, and all that stuff, right? Asset allocation stuff. So bonds have been, the 10-year Treasury has been around 4.5% or so, give or take, for I'd say, the last 18 months or so, somewhere around there. What are your thoughts on interest rates? What are your thoughts on how inflation would affect interest rates? You've already touched on that a little bit. But as far as like the investor is concerned, and especially in light of 2022, where there was nowhere anybody can hide, what are your thoughts on interest rates for the rest of the year, for the foreseeable future, and how should we be thinking of it?
No, it's funny because I'm about as constructive as I've been on the bond market these last few years in a very long time. And that doesn't mean that there's not risks. If we get an outbreak of inflation like we saw in 2022, that's definitively bad for the bond market. But there's something that we have here in 2025 and 2026 that we didn't have in 2021 and 2022. And that's a high interest rate. You know, one of the things that was a real overhang for the economy, the U.S. economy and the U.S. markets coming out of the financial crisis, we had the financial crisis from 2007 to 2009. The Federal Reserve lowered interest rates to 0%. And they kept them there forever. I mean, it was 12 years they kept interest rates at 0%. So if you are retired or you're going into retirement and you want to generate some income without taking on a whole lot of risk, you could go down to your local bank and put your money into a savings account and get paid 0.0 nothing percent interest on your savings account. Or maybe you could go and buy a CD for 18 months or 2 years and get paid like 1%. Thanks, you know, I'll go to the movies by myself. I mean, there was no interest to be earned in the fixed income market. And the only way that you could get interest is that you had to own long-term bonds. Okay, so I'll go out and I'll buy a 10-year or 30-year treasury bond, and it's going to yield me like 1.75%. Thanks. I'm taking on all this interest rate risk, and I can't get any yield. Well, here we are now. One of the best things that came out of the 2022 inflation outbreak is it finally forced the Federal Reserve to break the fever. We got an inflation problem, so we're going to raise interest rates by 5.5% to finally get back to normal for the first time since 2006, 2007. It normalized the market. So now we have a situation, you say, hey, you know what? I'm worried about inflation breaking out. Well, you know what I can do is I can go into the marketplace and I can buy short-term bonds now. I can buy a 3-month T-bill from the U.S. Treasury backed by the full faith and credit of the U.S. government and get paid an annualized yield of 5%. And if we have an inflation outbreak, all right, then I'm going to get paid 6% or 7% or 8%. We now have the ability as bond investors to do what's known as shortened duration. You can reduce the price volatility in your bond portfolio and get paid for it in terms of a yield that's 3.5%, 4%, 4.5%, 5%. So it provides us an opportunity for bond investors to continue to be invested in bonds, to generate income, and also protect against price volatility. I'll take it one step further. Everybody, I shouldn't say everybody, there's been concern about the outbreak of inflation in 2025 because of tariffs. But what happens if it goes the other way? And instead of having an inflation outbreak, inflation continues to, the whole idea is like, well, if tariffs could cause a recession, that would cause inflation pressures to not be as bad, and inflation comes down as instead it goes up. Well, if we have an economic recession with low inflation, that's great for longer term bonds. And you can get a positive price return at the same time. So there's definitely risks that need to be navigated, but there's a lot more opportunity, and there's some income that you can receive now that didn't exist a couple years ago.
So liquidity is not just good for the market. Liquidity is good for the GDP at large. Good, I use that term loosely. Generally good, right? If interest rates are, let's say, stay around here, let's say 4.5% or so on the 10-year, something like that, that really gives a certain cohort in the economy a decent amount of monthly liquidity to go out and do awesome things like, traveling, going to Spain, going to Italy, going to Portugal. No plug on my part. I'm not biased whatsoever about Portugal. So, What are your thoughts on that? Like, is there any contribution to the economy and therefore to the market because investors are able to get a little bit more interest off of their money?
Yeah, it's one of those balancing acts. It was one of the things that I used to find frustrating during the post-financial crisis period is that so much effort was being taken with zero interest rate policy to encourage risk-taking, But that risk-taking, that risk-taking encouragement was coming at the expense of the risk-averse. You know, people living off of fixed incomes, retirees, people who needed that income. They were the ones that were paying the cost to encourage investors to take on risk, to try to grow the economy. And we have exited that now. We're at an interest rate with the Federal Reserve at 4.25% to 4.5%. It's high enough where those who are living, you know, on fixed incomes can still generate income to support their lifestyles without taking on too much risk. But the interest rate is also low enough where, I mean, stock market's doing just fine at over 6,000 on the S&P 500. We are at a good fulcrum here, that balancing point in terms of being able to stimulate growth while at the same time still providing the ability for fixed income earners to generate good income with a low amount of risk. So we had a Fed meeting today, and the Federal Reserve didn't lower interest rates. And investors, and we did get 1 percentage point worth of rate cuts in the fourth quarter of 2024, but that was the exception. If we go back to the middle of 2022, at the end of 2022, investors have been clamoring for rate cuts. It's like, oh, when's the Fed going to cut interest rates? And when's the Fed going to do it? And like, oh, 25 basis points. Can't wait. The Fed didn't. We've been anticipating the Federal Reserve cutting interest rates going all the way back to 2022, and outside of that brief stretch at the end of 2024, we haven't gotten those rate cuts. But the U.S. stock market and the U.S. economy has done just fine along the way. You know, we've seen really strong rises in the economy and growth in the economy. We've seen really strong rises in stock prices. You know, when we talk about investing, we're just as much psychologists as we are investors. And we see that really play out with interest rate policy. If the market thinks that it's going to get rate cuts from the Fed, it's like when you're at the beach and you're walking along the beach and you see the ice cream cone at the ice cream stand. You say, God, that ice cream looks good. And you think about having that ice cream, you have that anticipation, and you look forward to it. But then once you have the ice cream, you're just like, God, I wish I didn't have that ice cream. I kind of feel lousy now from having that ice cream. And it's and sometimes you don't. When the same thing applies to Fed and monetary policy. You have interest rate cuts. More often than not, it will be the anticipation of interest rate cuts that help encourage the market to go higher. Sometimes, we saw it last September, the market got 50 basis points of an interest rate cut, the bond market hated it, and the stock market didn't really do all too well in the aftermath of it either. It's the anticipation of rate cuts. As long as the market thinks that those rate cuts may be coming at some point in the future, a lot of times that's enough to push the stock market higher.
It's like we're like little kids. You know what I mean? It's the anticipation of getting that prize after doing the chores that makes us do the chores. All right, let's move on. Let's go to international investing. Okay. I'm going to say, generally speaking, most investors have a home country bias. That's pretty true across the world. You know, European investors invest in Europe, American investors invest in America, so on and so forth. The U.S. stock market has consistently beat the world ex-US stock market like crazy, like over the last 5 years especially. Okay, this year something is different. If you guys can see the graph up there, this year something is a little bit different. Can you go into that a little bit? Talk about international investing. Why maybe a good time to go in there? Maybe valuations, maybe something else. Can you?
Yeah, absolutely. I mean, the U.S. bias, or we refer to it as the U.S. bias, where you say, hey, we live in the U.S., the U.S. stock market's doing just fine. Why do I even want to bother investing outside of the U.S.? And that philosophy has been rewarded for years. We go back to April 2010, and this is when the deviation started to take place. You look back over history, and there's a very high correlation between the performance of the U.S. stock market and the performance of non-U.S. stock markets. But starting in 2010, we entered into a phase where the U.S. stock market did fantastically well, while the developed international and emerging markets were basically stuck in the sand and went all but nowhere over the next 14 years. And that's made investors inclined to think, like, why do I even want to allocate to the US, outside of the U.S.? Well, it's really worthwhile to put it into context of history, as well as the factors that have driven what we've seen over the last 14 years in the U.S. stock market. So let's start with the historical perspective first. Let's go back to 1965. If we take a look at the stock market, the global stock market going back to the mid-1960s, international markets, so I'll cluster international and emerging together. Non-U.S. markets outperformed U.S. markets for 30 years, from 1965 to 1995. And I'm sure some of you remember the late 1980s when we had the Japanese stock market bubble where the Nikkei 225 average was just going up and up and up, and we turn on our news and we would see, traders in Tokyo, because it was such a big deal. That was true. That was coming to the end of that period from 1995 to 1995 to 2002, U.S. markets outperformed international markets. From 2002 to 2007, 2008, international markets outperformed the U.S. Kind of flattened out there from 2007 to 2011. It was kind of a break even. 2010 to the present, the U.S. has outperformed. So we're talking about 60 years worth of stock market history, and collectively, the U.S. has only outperformed about 20 of those 60 years. It just so happens that the last 15 years have been 15 of those 20 years. Markets move in secular cycles. So that's the first thing that's important to remember. But the second thing is that, we've been hearing this story for years that, well, look at the value that international stocks offer relative to the U.S. What a great value opportunity they offer. I've been hearing that since 2017, and U.S. stock market has consistently outperformed international markets. So why should it be any different now? Well, the reason it could be different now has to do with the U.S. dollar. The U.S. dollar is a currency that trades with the euro, the Japanese yen, the British pound, the Swiss franc, Swedish krona, all different types of currencies around the world. One of the things that will dictate the returns that you receive from your non-U.S. investments is how strong is the U.S. dollar relative to those global currencies. A big portion of the return of your international investments come from those currency effects. One of the things that we've seen throughout history, and we'll work with the most recent history. We'll start with in 2002, the U.S. dollar index was at a record high relative to international markets. And we saw a dramatic weakening of the U.S. dollar from 2002 all the way through 2010, 2011. What markets led during that time period? International stocks led the U.S. What have we seen since the middle of 2010 all the way up through the end of 2024? We saw about, doing the math in my head here, it's about a 60% strengthening of the U.S. dollar relative to global currencies. The reason that developed international stocks have underperformed the U.S. is because of dollar strength. One of the things that we're likely to see from these tariffs that are being imposed is that the U.S. dollar, which is up until the end of last year was trading at a historical high relative to global currencies, has been weakening. We see these cycles play out over multi-year periods. If we enter into a period where the dollar now I don't want to get nerdy here, plus 2 standard deviations above the mean, which means it's way above average. If we see the U.S. dollar fall from record strength to neutral or to weakening, that is the exact type of environment where we could see international stocks start to meaningfully outperform the U.S. And the tariffs that we're seeing being implemented right now could be the catalyst for that type of shift to be taking place.
That doesn't mean that we want to sell all of our U.S.-based stocks and go into international investing. However, what does that mean as far as for diversifying as investors? Now, I mean, we handle the investments for everybody here for the most part. So we would figure out that asset allocation for you. But even inside people's 401ks, sometimes one of the questions we get is, like, oh, how should we allocate our 401k? I mean, what's this international thing? It's dog. I've never seen it do anything for the last 5 years. So does that mean that we should just put everything inside international, or should we just use it as part of like a broader,
Yeah, that's really the thing, is that the U.S., there's a reason why everybody's trying to get here. There's a reason why we have an immigration debate that's going on. The U.S. is the global growth leader of the world. It is the preferred destination of capital for the world. And that's not going to change anytime soon. And that doesn't, there's a lot of things that go on in terms of politics and, both sides and the debates, and even the tariffs are being implemented. The fact of the matter is that we are the global safe haven destination for capital, and that's not going to change anytime soon. So the growth expectations inside of the U.S., corporate earnings expectations, they are still strong. So, maintaining a U.S. allocation certainly makes a lot of sense. The advantage that we potentially have going forward is that whereas international investing may have not provided as the quality of complement to our U.S. investments that we had wanted to over the last 15 years, we may be entering into a period where we're getting some additional help to our portfolios from international and emerging investing, whereas we weren't getting it for so many years. So still worthwhile to stick with an international weight, but if you might have been underweight to international investing previously, it might make sense to move to more of a neutral weight and a kind of a standard asset allocation neutral weight versus what we've seen in the past.
Thank you. So we're heading into the last, basically the last question here, but I want to build on something as we go into the next slide, if we can. The red line stands for the leading economic indicators, and the blue line stands for the coincident economic indicators, okay? Now that's a very academic way of saying that the red line is supposed to tell us what the economy is going to do, and the blue line is supposed to tell us what the economy is doing, okay? Since 2022, the red line has basically been telling us that we should be in recession, okay? This is really a major reason as to why you hear a lot of pundits saying like, oh, we're going into a recession, oh, we're going into a recession, oh, the market's unsustainable, we're going into a recession. So that's one of the reasons why you're seeing that. However, whenever they take these surveys with the coincident economic indicators, it doesn't tell that same story. It tells the opposite story, okay? There could be a few reasons for this. One reason could be that a lot of the data that goes into the leading economic indicators like manufacturing, new orders, things like that, they may not necessarily be what the economy looks like today. The economy today is like a 70% service-based economy, and that's not really captured inside the leading economic indicators. So that could be a reason. They say that maybe, the effects of the Fed rate hikes just haven't really come in yet. I think that train left a long time ago. I don't think anybody can really validly use that excuse nowadays. Or maybe we're in a new cycle now where some of these old indicators that we've been using for the last 50 years, maybe we can't really use them anymore, right? Because the economy may be different now than it was back in the 50s, 60s, 70s, and even 80s. What are your thoughts on that? And then with that in mind, how can we as investors really look at the future and what kind of confidence can we have? And I'm saying like maybe a little bit more long term, not just like 2025 wise, but like in a more secular way, like how can we have more confidence of what the future is going to look like if we don't really even have adequate markers?
No, because you hit on a key point there. One of the challenges associated with some of the economic indicators, I'll watch like the industrial production indices or the Institute for Supply Management to monitor manufacturing activity. one of the realities is that the United States is increasingly becoming a service-based economy. You know, we are the buyers for the world. There is a definite emphasis with the current administration to try to bring some of that manufacturing back to the United States. So that may bring some of these indicators, more into focus than they have been, in terms of relevance and in terms of accuracy than we've seen in recent years. But the fact that we're more of a service-based economy is not likely to change going forward. We've seen these indicators, and you take a look at that up there, and there have been points where it has been accurate in predicting recessions. And we may very well see an economic recession here in the second half of 2025. Current projections for economic growth remain strong, but it may be a situation as we get. I remember when the current projections for economic growth looked strong in the second half of 2008, and that didn't play out so well. So, forecasts are only as good as the weather. So it could be that we see a recession, and maybe those indicators are correct. But if we do, that's not necessarily a bad thing. Economic recessions, although they're not pleasant, and people lose their jobs, and people have to adjust, there is a healthy cleansing process that goes on for the broader economy as a result of the economic recessions that we've experienced. I think back to the financial crisis in July and October of 2007, the S&P 500 peaked at 1554 on the S&P before we entered into the financial crisis, and over the next 18 months to 2 years, the S&P 500 fell to 667 by March of 2009. And then we fast forward to the COVID crisis, where the S&P 500 peaks at 3319 in February of 2020. I still remember that day. I was at the gym, and I heard that COVID cases had broke out in South Korea, Iran, and Italy, and you knew the game was on, that the whole global economy was going to shut down. And the S&P 500 fell from 3319 to 2181 by March of 2020. And those were just two of the economic recessions that we've seen over the last 20 years. But where are we today? Those are painful adjustments that we went through. The financial crisis and COVID. The S&P 500 bottomed at 2161 or 2181 in March of 2020. It's trading over 6,000 today, 5 years later. The economy recovered. We've seen strong economic growth since. It's the focus, and thinking about the work that Ricardo and Charlie and Phil and the Paragon team do, it's that long-term plan and keeping a focus on the long term and recognizing a proper asset allocation is built for those periods of short-term weakness and short-term fluctuation, but sticking to that long-term plan and weathering those periods of short-term weakness. History has shown that that's been the key to success, and we're likely only to continue to see that for the next 150 years.
Thank you, Eric, for that. That is all of the structure questions that we have for tonight. I'm going to open the floor for questions from you guys. I'm hoping for a lot of questions. I want to try and make this as interactive as possible. So anything you guys have on your mind, please feel free to speak up. Phil's going to be roving around too in case you guys are a little shy to speak up, and then he can relay the question to us. Go ahead. So Eric, the question, if I may restate that, is the administration still does have higher tariffs than there were, and they are making some receipts on those tariffs. I think I actually did hear a number recently that they received, I don't remember the number off the top of my head. I think it might have been like $300 billion. I might be mistaken. But they did receive a decent amount of money in receipts from added tariffs. How do you think that'll affect the market, maybe the economy, or maybe even better yet, the debt?
Yeah, I think it's just like geopolitical risk. I think the market works right through it. Now, Liberation Day on April 2nd is a contrast to that. One of the things that happened coming out of Liberation Day, the market was expecting tariff rates to be anywhere between about 10 to 14% against countries all around the world. Corporations we talk about investors don't like uncertainty. Corporations don't like uncertainty either. And you know, the market was prepared, corporations were prepared for tariff rates that were going to be in the neighborhood of 10 to 14%. What shocked the market on April 2nd was that they got tariff rates that were like 30%, 46%, much higher than what the market was expecting, much higher than what corporations were expecting. We have Liberation Day 2 that's coming up here on July 9th. It's my expectation that when that day comes, it's not going to be the administration saying, okay, well, this is what is. It's going to be an opportunity for think about our current president. What's his book? The Art of the Deal. Hey, we're open for business. We're open for deals. Come and negotiate with us. It will be a continuation of what we've seen up to this point. The markets will adjust as they always have. It was true during the first Trump administration. There were tariffs that were imposed during the first Trump administration. There was concerns that those could be inflationary at the time because they were being imposed against China. The markets adjusted, producers adjusted, and there wasn't a sustained material impact. I think it's reasonable to expect the same. Could there be short-term pain? We could maybe see a compression in corporate profit margins, maybe a reduction in corporate earnings. Absolutely. But once companies have the numbers that they can plug into their spreadsheets and adjust their production and adjust their businesses accordingly, what is the intended purpose of the tariffs is to try to encourage production to come back to the United States. There's an adjustment that will take place. That could have an effect on corporate earnings, but that's part of what we're doing on a day-to-day basis. Managing investment portfolios is taking a look to say, okay, well, where are those impacts going to take place? And where are the opportunities associated with those adjustments? Because as we've seen, and this goes all the way back to ancient Greece. Tariffs were imposed, the markets adjust, and then everybody goes on their way and the economy continues to grow. And I think we'll see the same thing this time around.
So the question is, how important is national debt? You might kind of sum that up nicely for you. How important is national debt? What's the tipping point for national debt, and how should we be thinking about that as investors?
So this is an issue that's been going on for years. We used to balance budgets and run surpluses in this country. If you go back to the 1960s and 1970s, or that brief period of time in the late 1990s and the early 2000s where we actually had some budget surpluses. But other than that, we've been running deficits and increasing the national debt for decades now. I can remember when I first started teaching college back in the early 2000s, and the national debt had hit $5 trillion. And at the time, this is unsustainable. We need to do something about it. Well, now we have a national debt that's 6 times as much. There will be a day of reckoning associated with this. But in the meantime, the markets will look right through it. A good example for comparison for this is Japan. Japan is a country that has run deficits and debt well in excess of what the United States is doing. And, their interest rates have been among the lowest in the world in terms of their government debt for years. People have been willing to lend money to Japan. People have been willing to lend money to the United States for years, despite the fact, to your point, the debt to GDP ratio is now in excess of 100%, which, historically anything north of 90% was kind of considered the tipping point. The world, on a sovereign basis, different countries continue to accumulate debt, and it only continues to grow. There will be a point where we reach a day of reckoning where our entitlements, healthcare, Social Security, national defense, the interest on the debt, start to become a meaningful drag against economic growth. You say, when is this likely to start to manifest itself? The 2030s, probably. You know, if you go back through time, the 30s are a really bad decade in centuries. You know, the 1930s, we know all about that with the Great Depression. The 1830s, we had the Panic of 1837, and basically that was a bad stretch during the Van Buren administration. The 30s have been a tough time, you know, and we may see the same thing again. And part of the reason for that is demographics. Because by the time we get into the 2030s, we're going to have pretty much all of the baby boomers retired. Some of those baby boomers are going to be getting to the advanced ages of retirement where they're going to be requiring more healthcare support. And it's going to be the Gen Xers who are in their peak earnings years, a significantly smaller percentage of the population that needs to fund all of these entitlement programs. So it's a problem for the 2030s. We see that problem manifesting itself in Japan for years. And demographics, more than anything else, is the determinant of long-term market health. So, you know, we're a few years away from that, but that's something that's still worth keeping an eye on in the meantime. Exactly. The decline, in all seriousness though, the decline in the birth rate, I think about my son, he's applying for college next year. And all these colleges, the demographic cliff, 2026, we have a big demographic cliff. A lot of people a lot more people stopped having kids 18 years ago, 17 years ago because of the financial crisis. We came out of the financial crisis and birth rates continued to decline. That's bad for this country. And you know, that's one of the challenges. It's looming out in the distance, and it's something that, you know, we need to think about as we're allocating portfolios today.
The 2030s also coincides, I believe, with the millennial generation, which is the next biggest generation after the baby boomers. Their peak is hitting in the 2030s for their peak earning years as well. I think I'm literally either the oldest Gen Xer or the youngest millennial. I'm not exactly sure which one. I was January 1st, 1980. So anybody that can tell me which one I am, I'm not sure. I think I kind of ride that border. But choose which one you want. Yeah, I'd rather be Gen Xer, I think. But I think that also coincides with that as well. So yeah, the 2030s is something that's in the back of my mind also. I would also further say that while the U.S. dollar is the leading currency in the globe and is the currency that is used for trading across the world, most trade happens in U.S. dollars. Most financial transactions happen in U.S. dollars. As long as that holds true, the debt won't be as big of an issue as some may say it will be. However, that doesn't mean that at some point in time there's not a diversity among currencies. Not that maybe one currency will automatically displace the dollar, but maybe just the U.S. dollar is used less. And we don't really know what kind of an impact that's gonna have, right? So while it's not a problem now, and it's like Eric said, it's a problem for later. It's something that really the government should be looking at now, so that it isn't a problem later. It's one of those things. Next question. Who else? That's a good question, Ray. So I'm going to repeat the question for everybody who may not have heard. So with some deportations that are happening, it could squeeze the lower income jobs. With unemployment already, statistically really, really low, and job openings still abound for now. What kind of, what do you see that may happen while deportations are happening at the same time as still a good job market? And I'm going to actually add a second part to that question, Ray, if you don't mind. With the continued acceleration of technology, and with companies that you're hearing saying that, like I think I just heard Amazon saying that they're going to try and keep reducing their workforce over the next few years. A lot of that are going to be white-collar jobs, typical white-collar jobs. It's kind of like a weird dynamic where you have a tight labor market on the bottom side and then maybe a looser labor market on the top side. That could have effects on the GDP. What are your thoughts on that? Yeah,
so it is going to be a key issue to watch. We talk about the number one downside risk to financial markets and the economy and going forward is the threat of a renewed rise in inflation. These are the types of forces that can lead to that. You think about, we talk about the demographic issue, and you want population growth. We think about the United States of America, give us your tired, your poor, your hungry masses. One of the reasons that we wanted immigration in this country for so many years is because it helps foster and support economic growth, this population growth. But it is a supercharged issue, and has been for a long time now, is in terms of, what type of immigration do we want? What type of immigration do we need in this country? And those are some of the unintended, or some of the consequences associated with a crackdown in immigration, is that there are a number of unskilled labor, and that's the economic term, unskilled labor. You're basically, jobs where you don't require training in order to complete them. Workers that are jobs that are primarily filled from people who are coming here from other countries. So where are we most likely to see the direct impact of that? We're likely to see it in certain food prices. We're likely to see it on a micro basis, at least initially. And that will be some of the warning signs to look for, is that you'll see things on a micro basis, like on an individual basis. Does the price of cherries increase? Does the price of almonds increase? Does the price of mushrooms increase? And that can eventually spread to a macro basis. So it's one of the things it's a definite risk to watch for. And do we see it actually manifest itself in terms of prices going forward? So it is a key risk to watch for. On the flip side of it is the point that Ricardo raised, is at the higher end. Another concern that we hear, and I've been hearing this for years, I talked about all of the advantages that can be derived from artificial intelligence. Well, one of the potential disadvantages from AI is, the things that AI can do will render some of the work that people are doing in their jobs, will render the work that they're doing obsolete, because AI can now do it. And that raises questions about, will there be people that are going to be, is there a segment of the economy that's going to be put out of work because of the advent of AI? And the point that I would make with artificial intelligence is the same point that I would make for the internet in the 2000, when it was right around the turn of the millennium when the internet came around. The personal computer in the 1970s, the mid-1970s, the mainframe computer in the 1950s. These are all major advancements in technology that helped propel our economy forward in terms of economic growth. That, you think of the personal computer. What employees, what industry went out of business because of the personal computer? What employees were lost as a result of the personal computer? Typewriters and secretaries. But what did those people do who used to be working at the typewriters typing memos? It freed up their time to do more value-added work. Okay, the secretaries of the 1970s, the administrative assistants of the 2000s and 2025, freed up their time to do more value-added work. We're seeing the same thing with artificial intelligence today. Things that would take hours to research, you can now have it done, boom. I could pop on my phone, get an answer for something in a second. It frees up our time to do even more value-added work than we were able to do before. So could it put certain people out of work? Yes, but we adjust, and we end up with potentially better, more value-added work and workers as a result of that. And I think that's only the latest in that continual 25-year cycle. What we have here in 2050, it'll be interesting to see. Hope I'm here to see it.
So an additional comment on that. So if you remember, we may not remember back as far as, say, 2020 and 2021. It seems like a long time ago now, a whole other lifetime. There was a really tight labor market, and employees ruled the roost, right? Like, they had to have play sand inside their corporate centers, and badminton, tournaments, and pool halls, and in the conference rooms and things like that. And I know somebody at the time that was working for a corporate American was like, I don't understand, these people are like bailing out of meetings and playing with kinetic sand instead. And you couldn't say anything about it because you couldn't afford to lose an employee. Now things are slightly different. Where employers are starting to take the reins back and take control. And I think that for some people, it may be an issue, right? If you're not as productive as you can be, now is the time where maybe that employee might want to look at themselves and be like, okay, I need to start getting really productive because now it counts, right? And there's nothing wrong with having a little bit of balance. You can't have employers running 100% of the show. You can't have employees running 100% of the show. We always have to try and find that balance where, where an employee has rights and they're not getting overworked, and an employer has rights and they're not basically giving money away for nothing, right? Because they have to ultimately answer to their customers, their shareholders, and their stakeholders. So I'll say that. The other thing I'll say also is that, you hear a lot of talk, and it's really like, it makes for really good plugs and really good quotes when you say that jobs are going to get taken away by technology, and truckers are going to run out of work. There's not going to be a need for truckers anymore. We tend to forget that it's not just the fact that the technology exists that means that an employee is going to be out of work. Like, if there's an autonomous truck that's going to all of a sudden make deliveries for you, that's all fine and dandy. But all of the truck companies across the country have to adopt that technology, which means that the truck that they just bought for 6 figures, 5 years ago, that they normally last for 30 years, they're not just all of a sudden get rid of that truck to buy all new trucks, all new fleets. Okay, so there's a transition period that happens. And will some people lose jobs? Yes. Will they find other jobs? Possibly. So there's all of that we have to take into account as well. And as far as the deportation problem, I think sometimes we have to take a look at the situation and try and figure out how much of it is noise versus how much of it is really what's going on, right? And sometimes it's really hard to try and tell that difference. And I'll give you an example. You hear a lot about ICE going in and taking people out of hotels and restaurants and places of work and farms and things like that. But you also hear about the administration doing a slight public pivot, if you will, and taking a little bit more lenient stance on hotels, restaurants, things of that nature. And I think the reason for that is at some point common sense has to set in, right? You can't have all of a sudden, what's the estimate, 30 million illegal immigrants, I think, in the United States, all of a sudden be picked up and to be deported, right? It just doesn't make logistical sense to be able to do that. We don't have the funds to be able to do that. And secondly, you can't just get rid of all those workers, right? Because then who's going to replace those jobs, right? So there's a little bit of balance that has to go into, and as watchers of this, we don't always get the truth, right? We get what's fed to us by the media, the administration's spokespeople. So it's hard sometimes to make a real judgment call of what's really going on, because I feel like we never really have 100% of really what's going on inside. Speaking from an immigrant myself, for those of you that don't know, my family and I immigrated here in 1984. So I wasn't born here. I'm an American citizen. I served. I love it here. I'm not going anywhere else. But there's also a sense of law and order that has to be followed, right? My personal opinion, someone that happens to live close to someone else's backyard doesn't have the right or privilege to be able to just hop across the fence and go there because they can. Because there are millions and billions of people outside of the backyard that are also willing to give up everything to come here. My family was included in that. We had to buy plane tickets, come across. We waited 4 years for legal citizenship to be able to come here. And to me personally, and I think I'm going to say 99.9% of other immigrants that had to do it the right way, to come here to apply for citizenship have to wait 4, sometimes 10, sometimes 15, sometimes 20 years to get a visa to be able to come here and work and make a better life for themselves and for their family. It's unfair for someone else to just be like, oh, I can swim across the river or walk across this desert and be here, right? And I'm not at all taking away from the difficulties that those people have, because those people are trying to come over here by and large to have a better life for themselves and their family as well, right? But there has to be a certain order, or else there's just chaos. And when there's chaos, that's not good for anybody. That's not good for employers. That's not good for employees. That's not good for people trying to come over here. If you've heard some of the stories about, people that are getting taken advantage of because they're paying somebody to come over here, and they have to do it in a most god-awful way to be able to do that. Like, we don't want any of that, right? We want to be able to have things done in a certain way that makes sense for everyone, both for the immigrant and for the country in itself. But at the same token, if you've been here for 20 years and you're paying taxes, you're working, you have a house that you purchased, you have a family here, you're being a productive member of society, they're going to figure out a way to keep that person here because they need that person here, right? They're adding money to the Social Security system, which is vastly unfunded, right? They're paying taxes into a country that needs that money to be able to pay their interest payments and pay defense and pay everything else that goes along with it. So what I'm trying to say to kind of wrap that portion up is that they'll figure it out, right? We have to kind of sort our way through the noise to get to what's actually going to happen. And I think what you'll see is over the next so many months to years that you'll see a much more toned down rhetoric when it comes to immigration in general. Because the fact of the matter is that the country needs immigration. We're not having enough babies to keep the country going for the next few decades, right? The average family now, I think, is only having 1 point some odd kids, 1.5 kids or something like that. And that's just not enough. That's just not enough. So we need immigration. So they'll figure it out. It's just going to take time, and we just have to kind of avoid all the rhetoric and things like that. Go ahead. So in regards to international purchases of property here in the U.S., okay, in the agriculture, okay, so let me back that up just a little bit, just to kind of lay a little bit of a background to that, because I think I know what you're asking. So the question is, what's going to happen with international purchases of, domestic purchases of by international people of agricultural land. Okay. So a little bit of, and I'm sure you can explain this better than I can, so you can fix my mistakes if I make any.
No, you won't make any.
In economics, when you have the flow of money going one way or the other, right? As we're buying things overseas with our dollars, right? All of these countries are holding on to our dollars, right? But there's only so many dollars that they can actually hold on to, right? So when they have enough dollars, then they start buying our debt. They start buying our treasuries, right? So, but there's only so much debt that they can buy, right? So when they're done buying our debt, then they go ahead and start buying other assets, liquid assets, or stocks, right? One of the reasons why the U.S. has one of the best stock markets on the planet is because the U.S. does a lot of trade with every other country in the planet, and therefore they start buying our stocks when they have enough of our dollars and our debt, right? Once they have enough of our stocks, then they start looking into other assets, real estate, land, buildings, things like that, commercial properties, houses, right? Things that are a little bit harder to get sold, right? So that's why we see a lot of foreign countries buying our agricultural land, our corporate centers, even some residential housing. So with that, I just wanted to kind of give that backdrop so everybody understands why another country would even want to buy our agricultural land. Go ahead.
So I guess your question then is in terms of what concern should we have in terms of, I guess not only economic growth, but national security in that regard. And, that has been a sensitive issue for years, in terms of all the factors that Ricardo outlined in terms of, property acquisition. We've seen situations where foreign buyers of real estate have basically priced domestic people who actually want to live in properties out of being able to buy those properties. The biggest issue going forward in that regard is, what steps are being taken from an administrative standpoint in order to regulate those types of purchases. You know, what's the potential national security effect? What is the potential, does it have a diminishing effect on the U.S. economy? We haven't really seen any evidence of that from a hard data standpoint. It's really a lot of capital flows. One of the things that used to be a big point of agitation for years was that, the point that Ricardo raised is that, we were so indebted to China and Japan in terms of our national debt, or in terms of our treasury debt, excuse me. That has basically kind of resolved itself over time. We are not nearly as indebted to China or Japan the way that we were 10, 15 years ago. So I think it's something that's worth monitoring, but in terms of it having a material impact, it has more of a micro impact than really a macro impact, at least in terms of the way we're seeing the data so far.
Anybody else? Awesome. All right. I guess that is all the questions. Thank you, everyone, for coming out tonight. I'm sure Phil will maybe do some parting words. Yeah? No? But thanks, everybody, for coming out tonight on behalf of me and Paragon and Eric.
Thank you, everybody. It's great to see you.
And I'd like to remind everybody to... our material is out there. It's on Facebook. It's on LinkedIn. We bombard you guys with emails. If it's too many emails, let us know. We'll slow them down. I know that sometimes there's more emails than others. Back in April, I was sending out tons and tons of stuff. I hope you guys found it useful. I've heard from some of you that you did and that you found it helpful at that time. So that's what we're going for. So if you want us to keep doing that, let us know. If you want us to keep doing videos and try and be as educational as possible for everybody, let us know. We'll keep doing that. And as they say in the online world, like and share. The more people that like and share our stuff, the more people get to see our stuff, and the more education they get. There's a lot of garbage out there, and we like to think that we're trying to offer some good, solid advice for people.